All right, we're gonna kick off our second to last panel of the day, hosted by Brian Gilbart of New York Stock Exchange. Everyone give him a warm welcome.
Good afternoon. Thanks, Chip. Appreciate it. Welcome, everyone. This is the Options Evolution Derivatives at the Core of ETF Innovation panel. I think we've got a good panel. We put some prep into it last week and into this week. So thank you very much. Also want to thank ETF Global for being one of the sponsors of this. Jack Kimmel for extending the invitation to moderate this. So thank you. My name is Brian Gilbart. I'm the head of Options Markets Development for NYSE Group. It's an intercontinental exchange company. I'm responsible for the NYSE Options business team. My team is responsible for tracking transactional KPIs, performing revenue and market share modeling and optimization, and managing commercial policy and strategy for NYSE's two options exchanges, ARCA Options and Amex Options, both of which have an electronic and open outcry trading floors, one here in New York City, down on Wall Street, and one in San Francisco. And yes, there are still trading pits that have trades going up in them. Prior to the New York Stock Exchange, I was an options market maker at Belvedere Trading in Chicago. It's a prop options market making firm specializing mostly in index and commodity options. And prior to that, I was on the ETF program trading desk at UBS Securities in Stamford, Connecticut during the global financial crisis, which is where I cut my teeth. So you learn quick when the market's moving 5% every day. So I'd like to introduce our panelists by name and then let them each do kind of a brief introduction of what they do in their areas of expertise. We have with us Connor Foley to my left. He's head of business development, security-based swaps for Merix. My nickname for him is the Magician. After that, we have Taylor Ranney, senior vice president with RecShares. He is the innovator. After that, we have Felipe Taves, founder and CEO of Taves Asset Management. I call him the blind spotter. And then lastly, we have Eric Polikov, head of US ETF capital markets for a small company called Invesco. I call him the aircraft carrier captain. So if you guys wouldn't mind doing a brief introduction of yourself and your areas of expertise.
Thank you, Brian, and good afternoon to everybody. So I'll tell you more about Merix because I think it's more interesting than I am. We are UK headquartered, albeit NASDAQ listed commodities and financial services group. We provide everything from agency execution in derivatives right through to we have physical trading businesses in oil, petroleum products, and various types of precious and non-ferrous metal, including a scrap business I just learned about last week. I've been with Merix for a little over a year. I'm a lawyer by background. Take what you will from that. And I came into Merix to help build a swap business, as we had found some interest in swap for leveraged ETFs, maybe also something to complement for our private fund clients, and maybe more novel ways of doing our Delta One business on swap. But our swap business has grown very, very quickly with leveraged funds in particular. And now we're putting together that business with what we do in options, what we do in futures, what we do in repo, with the funds that we act as AP, and then finding out, it seems to be every week, there's something else we can do and we should put it together as a business line. So I'm glad to be joined by some colleagues today. They'll be through the crowd talking to you about what they do. And if all else fails, we have a neat line of socks outside on our merchandise table. Help yourselves.
Beautiful. All right. My name's Taylor Ranney. I lead distribution efforts for RecShares, with a particular focus on our long-term buy and hold ETF lineup. Rex has three distinct businesses, just to give you guys a brief overview there. One is focused, like I said, more on long-term buy and hold ETFs. And we have two trading lineups. One is a partnership with Tuttle Capital Management, 2 times leveraged and inverse single stock ETFs. And then we also, through a partnership with BMO, have 3 times leveraged and inverse ETNs on specific concentrated sectors, things like big tech, big oil, big banks. We also have a sister company called Osprey Funds, which are private placement crypto products, which we are transitioning more into the ETF structure. So happy to talk about each of those. My background has been across a couple of different firms, JP Morgan, State Street, Janus Henderson by way of Velocity Shares. So I did have some exposure, not during Volmageddon, but to some of the ETN products and legacy ETN products that are slightly different than what we have today with BMO. But happy to talk about those. Always been client facing in different capacities, but excited to be here. Thanks.
Yes, Philip Taves, the Taves Asset Management. Our focus is on trying to provide access to core asset classes, but reduce the risk of significant loss. So fun going ahead, right? So we have 2 core products that we manage. One of them is a pure play hedged equity. It's a little different than defined outcome in the sense that it's designed to have greater loss avoidance measures as markets fall rather than less with certain defined outcome products. And the second category of ETF is in what we call adaptive fixed income. So other people might call it unconstrained, but we've employed the word adaptive, which means that you're trying to be in fixed income, trying to produce interest, but trying to be out of the way of rising interest rates or inflation issues. But when everything is benign, you're trying to maximize returns, in an otherwise positive market. Part of what division of our company that we founded back in 2011 is called the Behavioral Investing Institute. What we found over the years is that not just investors, but advisors time entrance and exits into hedged products very poorly. In other words, when markets are at the bottom, they want to buy these things, or after markets have moved down. So we built that Behavioral Investing Institute to attempt to help advisors communicate with their investors around how to actually buy and hold these things with good timing. So I'm excited to be here.
Hi, my name is Eric Polakov. I'm at Invesco. I've been in ETFs more than half my life. I was talking to some Webs people around here. I'm looking at you, Cliff, as well. It's like I remember trading on the Amex, and I remember what the original Webs meant back in the day. But anyhow, as Invesco, we manage in the U.S. 233 products, ETF-wise. We manage 1.9 trillion globally. And ETFs are about 800 billion, 600 billion here in the U.S. I love ETFs. I've been in ETFs for a long time, but we've just started kind of thinking about option strategies for our ETFs. But we managed the first ETF to ever to hold an option contract, and that was launched December 20th, 2007, PBP. It's only 140 million bucks, and it's even though it's that old. But we were the first ones to do it under the PowerShares brand back in the day. But we'll talk a little bit further about some of the things that we're thinking about from Invesco point of view.
Great. Thank you, panelists. So in this panel, we're going to touch on all nature of derivatives that live within ETFs, not just OCC cleared options. Obviously, a lot of that inventory is OCC cleared, but there's other derivatives that now sit within a number of different ETF creation units. I wanted to frame where we are right now. Most of you probably already know this being in the business, but just to frame it, the total U.S. listed ETP universe is about 4,200 ETPs. The number of symbols of that 4,200 that have options listed on them is approximately 1,800, and that represents about 10 trillion of AUM at that 4,200 level. And just to frame that, the total number of listed underlyings that have options listed on them is 4,500. So between a third and a half of all product that has options listed is ETP. Obviously, defined outcome, that universe is 400 plus symbols and growing quickly. And then I think we just touched on it, but the first ever ETF SPY listed on Amex in 1993. So it's been 30 years that ETFs have existed. Eric, you touched on PVP, and that was the Invesco S&P 500 buy right ETF, and that launched, I think, around 2007, like you said. Can you share anything on how that came about and how that first product innovation kind of came to market?
I can't. And I'll tell you why. I wasn't there. In 2007, I was actually working for the New York Stock Exchange listing ETFs. I mean, listen, I was transitioning from Susquehanna, where I was trading, to move to the New York Stock Exchange for listing. So it was right around that transition when I left. I believe Susquehanna was the specialist at the time of that product back on the American Stock Exchange. I mean, listen, I think it's the thinking back then. Now, again, PowerShares was born in 2003 in a sleepy little town called Wheaton, Illinois, and Invesco bought it 3 years later in 2006, and this product came out in 2007, right? But the leaders of PowerShares back then, and a few of them are still here in the room, we're thinking about how to look at the equity markets and not think about market capitalization, right? They were one of the forefront of thinking about things of how to look at the economic value of a company, not through shares outstanding times share price. And I think this was just an evolution of that thinking, to think about what sort of downside protection. It's a buy right strategy, very simple. It bought S&P 500 contracts and just kept rolling them. And long story short is that's where I think the evolution of the thinking of getting away from just strict market cap, because at that time, it was BlackRock and iShares back then, and BGI and basically Vanguard and State Street, right? And that's all just market capitalization stuff back then.
Great, thank you. ETF growth has been steady over the last 30 years, eating into mutual fund AUM. And really in the last 3 to 5 years, we've seen this explosion in the use of derivatives, to the point where there's hundreds, if not thousands, of products now that have options within them. Taylor or Eric, not to state the obvious, but can you recap for us some of the benefits of ETFs?
Sure. I'm sure everybody here is pretty familiar with the core benefits of ETFs, but just to throw it out there very quickly, you have tax efficiency, you have liquidity and tradability, you have low cost, you have access now to a wide swath of different asset classes that you perhaps didn't have in a retail format. Might be missing some, but I think at the highest level, that usually covers it.
Yeah, I mean, I just think about why is the ETF even here, right? And again, Cliff Weber, I'm looking at you. And if you don't know Cliff, go introduce yourself to him. Cliff, raise your hand. There you go. One of the original Amex lawyers making the production of the ETF. Think about the financial crisis of '87 occurs, the market crashes. People are still using phones to call up to sell something, right? It's impossible to get to the exchanges to sell your shares of IBM, your futures, whatever the case may be, whatever you're trying to sell, you couldn't. So the folks over at State Street and the American Stock Exchange developed hey, well, you know what? We could think about this type of product that holds all of the stocks of the S&P 500 in a share that trades from 9:30 to 4 p.m. Eastern, right? And a couple cracks at the bat, with the SEC, they couldn't really get it through. And then finally in 1993, they did. And I think that's really the result of an ETF and why we're here today, 20, 30, almost 30 years later. So I think that's ultimately what we need to understand, why it came about, what the benefits are, and really the technology that the ETF wrapper provides versus mutual funds, UITs, closed-end funds, et cetera.
Great, thank you. We touched on Invesco's first ETF. Taylor, can you touch on RexShares' first ETF and what that was and when that came to market?
Yeah. So RexShares has been around since 2015. Cut our teeth in the ETF space first. In 2016, we launched 2 ETFs, April, I think it was. And full disclosure, I joined in September of last year. So when we were talking about this, I had to do a little bit of digging. But it was an S&P 500 exposure with gold futures as a hedge. If you think about 2016, there's a couple of things to unpack that with. One, equity markets were just ripping. So you were underperforming. What everybody wanted at that point was just cheap passive beta. That's what you were performing with, right? And so there's that piece. There's another piece of low inflation. So the strategy just didn't take off, and we ultimately liquidated it in 2018. But when you think about launching products, and if you think about from the perspective of a startup in general, you have to pivot, you have to change, you have to think about what you're doing. The core of that product, was just general equity exposure. We had futures and derivative exposure, which has been a core theme throughout all product innovation that Rex has had here. But when you think about what's made our product base successful today, you really have to step back and think about what from the advisor's perspective or what from the investor's perspective is going to draw them into this strategy, right? So if you can come up with a product that not only has, easy portfolio use cases for advisors to understand or for large institutions to understand, What's unique and different about today is that you also now have this end user retail client base that can make products really, really interesting. So from a timeline perspective, we had those strategies. They're maybe a little bit more complex. Advisors always want to allocate. It shows that they're adding value for their clients and not having fully packaged products always. And then we launched our ETN business in 2019. Today, that's about $2.5 billion. Like I said, it's exposure to concentrated baskets of securities on different themes, 3 times long and short. That has a very, very unique but very obvious use case. It's for traders. It's for people who are in and out of positions very quickly, want exposure fast, and they want to express that conviction that they have, right? The ETF world didn't work for us in that sense. We then partnered with Tuttle Capital Management in 2023 and launched 2 times leverage. And we were the first to actually effectively get 2 times leverage on single stock ETFs or within the ETF structure. That took off because, again, people are looking to that. That's not just a US client base. There's a massive cohort of Asian investors who, from a cultural perspective, love investing in leverage and inverse securities. I think 20% of the Japanese market is driven by retail traders themselves. So again, that's been growing and growing and growing. And then the most recent foray from an ETF perspective that we've launched into is option-based strategies. And this is where it becomes really unique in terms of ETF issuers being able to build a client base and build a product suite, is that retail investors from the get-go for those products, which yield 25, 35, and 42% annualized distribution rates, retail investors are looking for that type of product and that type of exposure. What that does for us is then that gives us an opportunity to go to gatekeepers at larger platforms and say, look, we have assets, we have liquidity, we have a unique client base, and we have use cases for the advisor client base and institutional. So the market has completely changed from both what clients are looking for, but it's really important to be able to identify those use cases, especially with derivative products, because advisor and client education is the number one thing.
That's great. And kind of piggybacking on the international theme, Connor, you guys kind of have business throughout the world. Can you comment on really the growth of assets coming in from outside the US?
Yeah, indeed. Thank you. We do. We see issuers who are coming to the market here and say, look, we think your products that have been very successful here will play well in our home jurisdiction. Can we find a provider that can help put this together for maybe a foreign entity that's going to hold those positions? And, it's now well known, we work with Taylor and colleagues and others to help with UCITS vehicles that want to pursue these income and buffer strategies. And we also see equally US issuers that are saying, okay, look, we have wonderful capital markets here and great opportunity, but there are other jurisdictions with markets too, and we can maybe take our ideas here, go either provide foreign securities exposures or commodities exposures and be able to have that in a listed product here, distributed here for US investors. Or, hey, you know what? European investors are not that different. Their interests are similar. Why can't we go and we can compete there and take some of our IP and go and compete with the locals? So it's great to see that two-way flow. Great interest here coming in. Of course, we want to keep regimes that facilitate that both sides of the Atlantic.
Sure, thank you, Philippe. You do a lot of portfolio construction. Have you seen themes specifically as relates to derivatives within ETFs? As you've had clients come in and as you develop product, have there been themes in the growth specifically of derivatives in your portfolio construction, and where were those themes?
Yeah, so I'm personally a little annoyed at the word alternative. It's sort of like all this other stuff isn't working. Isn't there some alternative? And it's a broad category that's in a way meaningless. But what's interesting is that, I talked about the Behavioral Institute and the fact that people move towards things when performance works. What we've seen over the last 4 years is certainly a desire for alternatives in the fixed income space. So with 2022, where all of a sudden fixed income became a correlated rather than an uncorrelated asset to falling equity prices, started to create questions in advisors, from their perspective about where do I find solutions to this? And that continues today. In fact, one of the easiest conversations we're having with advisors is how do we think about potential chaos or negative things happening in fixed income? So the use of derivatives, and we use, as an example, we hedge away high yield and investment grade risk with futures contracts to try to dial down the risk of losses in that space. But equities is another great example where it doesn't take a lot of persuasion for the advisory community to say, are we worried, considering everything that's going on, and considering valuations, about the possibility of not just a short term, but maybe even a potentially multi-year decline in equities markets. So, in my opinion, it's really driven by when conventional asset classes are soaring, when bonds are doing great and stocks are doing great, there's really not a need for alternatives. And so if you look at growth of options contracts and futures within ETFs, I think that's what we're going to see. And it could even go much, much greater in terms of a percent of allocations if we see markets turn down at some point, if people ever lose faith, which it seems they won't in the equities market, but moving over the next couple of years.
Thank you. That's a good point. The path dependency of kind of product demand. So as we look at the landscape of derivatives within ETFs, I highlighted three kind of thematic large areas of growth and AUM that we've seen. So you have defined outcome ETFs, you have leveraged ETFs, both on corporates and equity indices, and you have digital assets. So especially with these corporate levered ETFs, these have been immensely popular: NVIDIA, Tesla, MicroStrategy. Once you have levered ETFs that then have options on them, you have multiplicative leverage in the system. I'm not saying that's good or bad, but besides just the pure leverage of it all, if any of you guys want to comment on how far this goes with the levered ETFs and what's driving this huge boom in AUM.
Well, I'll take that one, and with I suppose the appropriate disclosure of we write swap for, I think, approximately 70 today leveraged ETFs. We've seen the development of these since really 2022, and I must admit I kind of was a little bit ambivalent at the beginning, thinking, is this a really good idea? And yeah, it's great, we make money out of it. Is this all going to end in tears? And I've been impressed with really kind of how sensible people can be actually using them. And there are some very volatile products out there. I was looking at a number of them, or ones that we provide swap for off my desk. But you do see people taking these products and using them for purposes in their investment strategy. They are thankfully generally not burying them in their portfolio, not holding them, being surprised when they find them 6, 7, 8 months later. And we're not out there flogging them to widows and orphans. So I can see that it's innovation that meets demand, and it is sensible. It's not, we will find at some point somebody will come up and there will be that, I'm going to say, is the absurdity line, where beyond that it doesn't make sense because there's no real reason to have it. But what we've seen so far, I think, is, it's been created in response to demand. And as we have seen with some, if there's not demand, they won't survive.
Anyone else on that?
Yeah, I can jump in really quickly just to give some anecdote or context here. Like I said, I joined Rex in September of last year. We launched a 2 times long MicroStrategy ETF 2 weeks after I joined. It was $3 billion by November. So from Connor's perspective of there's demand for these products, I want to couple that with the importance of education. And I think that over the last decade or so, with leverage and inverse products in particular, that education curve we've been climbing up that education curve pretty substantially. And so it's a much more understood tool within the markets at this point. And I think with retail joining into the market, they really need to make sure that they're educated. But then there's multiple layers, right? So we're an issuer. We want to make sure that we are taking our responsibility. We're creating products. We're creating educational documents. We're putting on webinars for everybody to have access to this. Then there's also the brokers, and there are the gatekeepers. And one reason that people are using these products is because it's a simpler way for them to access leverage rather than using futures or options and having margin accounts set up within their brokerage.
That's a great point.
And I'd add to that as well, Tyler, because it's also a convenient way for people to hedge risk in their portfolio.
Tyler,
and
can I-
don't always think about this. Is the idea of, look, how many investors are going to be out there that are really going to be thinking about what their covered call strategy should be, or where they should have their protective puts. And all of a sudden now they have it in one single instrument that pings it in, takes that, if you will, has a professional do that for them and help them in that. And I see that as a good thing.
Can I ask a question? So when I was at the NYSE, we bought the Amex, so I got the ProShares account, and they were the first to kind of do levered and inverse funds using swaps. And then I listed Directions, first two products, November 6, 2008, right after Lehman Brothers collapse, and those two products were 3x financials up, 3x financials down. Like, what talk about timing is everything, right? At the time after Lehman Brothers collapsed, I don't think ProShares at the time was public with who they were swap counterparties are. Are you public with that in your prospectus anywhere?
Well, people can go on to Bloomberg and they can crack into any of the funds and they will be able to see it. It's something much that the surprise and I think sometimes the annoyance of my boss, he just goes, you know, what really 10 years ago you would, it would be inconceivable to go out and tell who you did business with in prime services. Now anybody can go and look and they can see, oh, hang on, MRX, it's a pretty good indication
I think,
that is.
We talk about, at the very beginning, we talk about some of the attributes of the exchange traded fund. And a lot of it has to do with the transparency, right? That mutual funds don't allow for. So that's why I just asked that question out, to you, to make sure that you understand who the counterparty risk is for a swap-based product.
And we're going to touch a little bit later on balance sheet and stuff of that nature. So on defined outcome ETFs, which I think of as duration and payoff profile, whatever the structure is, they've been a huge boom as well. OCC cleared flex option is now upwards of 2.5% of all OCC volumes. NYSE Group is executing over 50% of that, sometimes 2/3 of that. So that's been a big area of growth. Can you guys touch on how much you use flex and why flex is an important offering within this derivatives construct?
I can start and just give some context about what types of derivatives you're using across our different product suites. So we have 3 core covered call ETFs. They all hold between 15 and 20 individual stocks. We write on 100% on the portfolio. So from an ETF transparency perspective, you look at our holdings on a daily basis, you see every option position, and you see every individual security that we own. With 15 to 20 securities, using Flex becomes a little bit cumbersome and expensive. And so with those products, we're primarily using listed options. We did just launch within the last couple of weeks a single stock covered call strategy on NVIDIA. With that, it makes a lot more sense for us to use Flex, primarily because they can be cash settled. So in the case where it gets called away early, we don't have any disruption in terms of the underlying security and holding and positions within that. With some of the swap-based products, so I mentioned the massive growth in MSTU, which is our 2 times long micro strategy. You reach capacity limits with some of the swap exposure. And so ways that we can supplement that to still maintain the 2 times exposure is to then go into the options market. And this is typically where we would use listed options again to buy deep in the money options because they have a delta as close to 1 as possible. And you also get the leverage exposure just by having to put up substantially less capital for that exposure. So from our perspective, we're using listed, we're using Flex, and we're also using swap across those to achieve, in certain cases, similar goals.
Great, thank you. Felipe, I believe you have a new book out. I'm wondering if you can tell us a little bit about that. And I dubbed you the blind spotter. When you're doing portfolio creation and product generation, can you tell us about some of the kind of like 5 Sigma events that you're thinking about when you're putting stuff together? Is that driven by you guys? Is that driven by your client base? And, how are you thinking about these kind of like unexpected events in terms of product that you list and using options within those?
Absolutely. Thank you for that, Brian. When you publish a book, all you do is talk about your book. And I'm the only panelist that has a prop. I published a book in March called The Behavioral Portfolio. You will be forgiven if you're all of a sudden on your Amazon app on your phone in the next 30 minutes. But anyway, the Behavioral Portfolio looks at the 60-40 portfolio as basically an historical accident where people initially used bonds to fund governments and later to fund companies. Stocks were a way of sharing ownership. At some point, someone came along and said, what if we put these 2 things together? And then Jack Bogle got on the scene and said like 60-40 is all you need to do. And so that's where we live. But if you look at different examples historically, what you find is that the 60-40 portfolio can lead to just basically utter devastation. Within the book, I walk through a worst case visualization going through the Great Depression of a 60-40 with real world factors of rebalancing and advisor fees. That balanced portfolio loses 72% in the first 3 years. Then it rallies and fits and starts for a number of years, and then it has another 5-year bear, at which the end of which you're down, around 60. So, that kind of an example, for if you're an advisor in the room, is unnavigable. It's like a nuclear bomb upon the advisory practice and our investors. So we're ignoring that. I created a word called the Corona bias, which means, back you had the Spanish flu back in 1915. 25 million people get killed. Later, we had another pandemic, and we have no immunity to it. And what I'm saying is that in the advisory community, what we're doing is ignoring parts of history, and we've lost our immunity to certain things that could happen historically. That was a really long answer so far, so I'll speed things up, Brian. But the point is this: the topic is options and derivatives inside of ETFs. And what I do is I deconstruct and build from scratch what it's like to build a portfolio that meets, not losing significant money, above inflation gains, and approaching it like that. What that looks like, Brian, is a modified return distribution chart where the right tail looks like a conventional portfolio and the left tail cuts losses short from inflation, stagflation, deflation, and it assumes you move the mean return left to pay for cutting the left tail short. So really, it's a question then of how do you do that, right? And so in our case, to have hedged equity means, we're going to try to correlate in a rising market, but we're going to try to lower risk of extreme events. One of the things that means actually is that, and I don't want to like thrash defined outcome, but do you buy insurance for the first 10% of your losses for fire insurance for your house? No. So you want loss, in my opinion, that gets stronger as markets move lower. So also adaptive fixed income. How do you get out of the way of train wrecks? Anyone worried about train wrecks in fixed income right now in the fixed income landscape? I mean, these questions are probably more important now, than they've ever been, especially due to the fact that we've got all this sovereign debt across every developed country, or virtually every developed country in the country. So I actually don't even remember what the question was, but I just talked for like 5 to 10 minutes. I think I've used my time.
I was plugging your book and giving you that.
I wrote a book,
opportunity.
finishing it with, I wrote a book, thank you.
So I mean, obviously we've got Invesco, we've got Rex. It's really a question open to all you guys. I'd like to step the audience a little bit through idea generation and then into timeline of product launch. Are most of the ideas internal? Or do you solicit or ingest external ideas? And how do you go from like a kernel of what about this, what about that, to launching? And what is the typical like product launch timeline at this point?
Yeah, I mean, for us, we kind of lately, over the last 2 years, we've kind of looked at where we've found success in our institutional mandates, and where we manage, and I'll talk about options here specifically, where there's been success there in growing assets. And it's generally through SMAs, in that space. But we took three SMAs and we kind of created ETFs, income advantage and ETFs. And these are basically designed not for the yield, but to really just provide income using ELNs, equity linked notes, which if you're not familiar with, they're basically what I call a bond full of options. They trade over the counter, and we ladder these options based upon the NASDAQ 100, the S&P 500 equal weight, and the EFA index. And we have 3 ETFs based on those right now. But that idea generation took probably about 3 years. It took us to educate an active portfolio manager how the ETF landscape works. What the ecosphere means, how transparent you have to be now, as opposed to an SMA where you don't have to be transparent except for the people that buy that SMA. And so that's one way. And then we also have a QQQ hedged product, a QQHG, where basically what we did is we took the buffered ETFs, and instead of you having to do your own roll if you own QQQ and do your own roll with the buffered NASDAQ 100 ETF, you can actually, we package that into a puzzle piece that sits within the portfolio and that rolls itself. So we take out the rolling that you need to do yourself and kind of package it for you in one ETF. And it's fully collateralized. There's no risk, there's no swaps, there's no leverage. The point here, though, is all these types of things that we're doing take time, and we're not as nimble as many of the smaller issuers out there are. Post 6C11, we've seen nothing but a plethora of ETFs come out, particularly in the active space. I think that narrative's out there. We all get it. But we're not throwing spaghetti at the wall anymore. Now, granted, PowerShares used to, not going to lie, 2008, 2009, that's what they did. But we have to be more thoughtful with our processes now as an institutional investor now. So that's sort of how we think about the world of ETFs.
Thanks, Eric. I'm going to keep us going here in the sake of time. And that's a good point on the rolling being built in and automated into the ETF or the ETN. So I want to talk briefly on investor education. Obviously, there's a kind of a bell curve spectrum there, from nascent retail and college level kids or adults to professionals. So I'm just going to throw out these topics. You guys can touch on them for a few minutes. Daily compounding and the risks associated with daily compounding, fees, product suitability, Greeks on Greeks, which means you have Delta One products that have maybe theta or gamma within the Delta One product and then options listed on them so that the actual options on the products have Greeks on Greeks, and then holding periods and performance. I know that's a lot, but as far as we're thinking about investor education, how do you guys look at those topics, those risks, those aspects of these derivative-based ETFs?
Wow, there's a lot there. I would just say this. Listen, the reality is the investment management side of the world teeters on two things: performance, fees, and education. So maybe it's three things. The point here, though, it's hard. It's hard to reach every investor out there to teach them how our products work. We try our best. We kind of publish as much as we possibly can. We hold webinars. We have a website. Like, we try to do as much interaction on TikTok and Instagram that PR allows not me to do. But the point here, though, is that like that educational piece is so hard. Holding periods, I have no idea, to be honest with you, on how long people should hold anything anymore. But I think that's ultimately it's a very difficult piece of our side of the world, is trying to help educate the outside investor.
I can add on here, I think.
Sure.
We have leverage and inverse products that we've all been talking about, but then we've also talked about buffered products. I mean, the outcome of those are very different. Daily compounding, I think, is something that, maybe 10 years ago, people got burned on more than they are today, or at least unknowingly got burned.
That's a good point.
Right? Today, I think if personally, I bought a 2 times long NVIDIA before earnings 2 months ago, or however many months ago. Got my face ripped off. It wasn't awesome. And that was a risk that I knew I was taking, right? And so I think that was more of a directional bet, but from a daily compounding perspective, you can do very well if you buy a leverage product and it goes up 3 days in a row, right? That compounding effect works to your benefit. It works to your detriment on the other side of that trade. I think, the way that some of these products have been structured, I don't know if we're going to go into the ETN world at all with this, but ETNs are the only way that you're really getting 3 times long or short exposure at this point. Some of the products that I used to work on at Velocity Shares were very different than the ones that we have with microsectors, in the sense that a lot of those products had underlying futures indices. And so on top of that, you had issues where oil futures settle at 2:30 in the afternoon and the ETN itself continues trading until 4. So if you get some announcement between 2:30 and 4 and the market moves massively, the leverage set for the next day is very different than what somebody who's unknowingly buying that and saying, I'm getting 3 times long, and all of a sudden they're getting 2.1 or whatever the case may be. So I think those problems are self-solving at this point. I think these products are a little bit more bought than sold. We don't do a lot of calling and just trying to get somebody to buy these products at this point.
I think, look, we have
on the leverage and inverse, to be clear on that.
And we have a different perspective, because I describe, what we do at Marex for clients like Taylor and his colleagues is we're the help. It's about putting it together. But equally, if you're going to come to us with an idea that we're going to think that you've had a concussion, we're not going to do it. And it is helping us filter out. The idea is, look, not every idea is a good idea. Not every product is going to be successful. And I do see, and we have seen, issuers taking the spaghetti against the wall approach that Eric mentioned. And, That's good, but it's only going to get so much of our balance sheet to be able to do it because, we know what your strike rate is likely to be.
So Connor, just to piggyback real quick, I heard today from Tim Riley, who heads our ETFs group at NYSE, that banks are pushing back on balance sheet allocations specifically for derivatives-based ETFs. You would be the one to be in the lab seeing that. Can you comment on what you're seeing? Do we reach a pause point, a breaking point as far as sell-side banks allocating their balance sheet to basically lever up these products?
Yeah, I say this, we compete with banks every day. We're in a business where traditionally banks have been the dominant forces. We're a non-bank clearing firm. We're a non-bank swap business. We're I suppose one of the fewer non-bank options clearing firms out there. And we got lots of different places that we do where people say, okay, we begin our description by saying we are not a bank, but we do all of these things that banks do in the capital markets. We don't have inexhaustible balance sheet. And we can see that, if you're an organization that, has so many different layers of management, you've got prudential requirements, you've got quite onerous supervision at times, it's hard to be able to move quickly with innovative issuers. And it's not surprising that, the go-to security-based swap dealers are not the big Wall Street banks. They're us, they're Cantor, they're Clear Street, they're, there are a few others out there to be able to do that. Do I see what I'm going to say is tightening up of balance sheet as a harbinger of doom? Not necessarily. I think it is a bit more cyclical. Having said that, I can see that one of the challenges, certainly with defined outcome ETFs, is there is a few big options clearers out there that are not interested in taking on more business.
That's helpful. As far as areas of growth, digital assets have been really big recently, and it's interesting seeing stuff that's off exchange come on exchange, have ETFs listed, have options product listed. Do you guys think, as far as growth, we might see really anything that has a recurring annuity or cash flow get wrapped into an ETF, even if it's not exchange listed, as far as new product in the next few years? Whether it's musical annuities or licensing rights or something else of that nature, are we gerrymandering and fiefdoming off even more product just based on wrapping cash flows?
My 2 cents to that. So digital asset wise, it will still be dependent upon the framework that's going to come out of DC, right? What's a security? What's not a security? Then can I put it in a 40 Act wrapper or a 33 Act wrapper? That's still TBD. The other things you're talking about, if I'm a prognosticator and where the puck is going, is tokenization of those types of things, right? Because you can't clear real estate through the DTCC. Doesn't mean you can't clear it. You'd have to trade it over the counter, and there'd be a contractual obligation. It just wouldn't be as flowing as your exchanges with regards to movement of securities. I think that's the bigger issue that we'd have to think about there. With tokenization, using the blockchain to settle things, that's where I think you'll get things like artwork and this bottle of water or whatever you want to put into a product, and actually then have clients purchase it from each other. And I think that's the real future of asset management, where I see the puck going, so to speak, with regards to that question.
I'll add to that there is that, if you will, the looming threat of tokenization to the ETF business. And I can see that many things, conceivably anything, can be tokenized and then use blockchain as a means of exchanging those between holders. At the same time, look what's happened with Bitcoin ETFs. I mean, Bitcoin had always been there, people to be able to buy and sell, and all of a sudden you put it into a regulated vehicle traded by regulated market participants on exchanges with available pricing and with rules around how you buy and sell it, and look at the growth. It goes from there. There are going to be times where there will be things that just should never be put into an exchange traded product, however it's described. we got an interesting list recently of coins and were asked, would we provide, OTC derivatives with these as underliers? And we said, yeah, we think about most of them. And then we drew a line through a few, including Fart Coin and Melania Coin. And, beyond that, we were interested to be able to do those. And there will be, as I say, there's that line of absurdity. But till we get there, I believe there's a genuine use case and a good reason to put many assets into an exchange traded product.
Sure.
And I do point out one thing that Taylor has brought it up a couple of times. I do think the exchange traded note is sometimes an overlooked and very advantageous vehicle for doing some of those.
That's a good point. So we have 5 minutes left here. I did want to see if there's any questions in the audience, just so that we can keep this conversive. Go ahead.
Just go back to a topic a little bit earlier in the panel. When we talked about listed options, flex options, and some of the derivatives you're using. Just kind of curious what the panel's take is on the capital markets ecosystem that surrounds listed options in particular, and the ability to in-kind contracts out of an ETF, and where that sort of is, right? Is it only flex options? Is it something that's going to happen with listed as well, or is it happening and it's just by appointment?
Good question. Thank you.
I actually think about an hour ago there was an OCC and SEC meeting to talk about this topic specifically. Right now it's just flex that you can in kind, and actual lights are out. Yep, so we got to go. The ability to actually in-kind options it's definitely coming down the pike. We just got to get the OCC and the NSCC to be friendlier, so to speak. And then the authorized participant community is just going to have to learn how to do it the way they learn how to do it with futures or futures for cash. But the point here is that it's just a lesson that should be learned. It's coming though.
Great. Any other questions in the audience? Okay. Well, I like the idea of the line of absurdity. I'm going to throw you guys out something I had as a backup topic. Failed product. How do we get to failed product? When does it get delisted? Why does it get delisted? Is it specific to having leverage or derivatives within it? And what are any takeaways as an industry we've seen from failed product?
I remember one that comes to mind: macro up, macro down. Does anybody remember these two?
Are those the overnight?
No, but that's another one that's unfortunately failed. But these two products were tied to each other: oil up, oil down. So if oil went up 1% on the day, the oil up ETF should go up 1%, and the oil down should go down 1%. Unfortunately, it didn't work that way. And so if oil contracts went up 1%, the oil up ETF would sometimes go up 3%, and the down one would be up 1%. Like, it's just the way the market dynamics worked for the ETF. It was just a colossal failure. And I think within the year they were gone, because it just failed. It just didn't work. It didn't do what it was stated to do.
I think I remember back with, essentially the challenges that we saw in the oil market back in 2020, and the lesson I took away from it. Again, I don't pretend to have any unique insight or wisdom on it, but we'll find the failures when we try to do a financial product on a market or asset that the issuer and the investor don't understand. Particularly, for example, where investors were holding and even issuers are looking without the concept or understanding what happens when oil goes negative.
Cool. I'm going to throw out some round robin questions. We've got just 2 minutes left here. I'll ask these 3 questions and you guys can choose one of them. So each of you can take one of these. What one ETF have you most traded in your personal account over the past decade? What's the highest peak you've ever summited? And what is the most esoteric ETF you've ever seen?
All right, I'll do the easy one. The most actively traded ETF in my portfolio is, because I'm an Invesco employee, QQQ, so it's kind of an easy one. But to be honest with you, we've got holding periods, so it's not really that active, unfortunately.
Very good.
I'll do the peak. I was dragged up Mount Kilimanjaro by the wife about 10 years ago, and it's 5,860 meters.
For those of us that are in the English system?
19,000 feet, 19,300 and change.
Very good. Philippe?
Okay, so it's not that esoteric, but one of my favorites all time is the meme, M-E-M-E. ETF, which is like you take a bad idea and then you package it so that you can have a worthless stock or group of them together. And that did fail, by the way. So
Very good.
I guess that maybe leaves me with all of them or none of them. Peaks, I'm not 19,000, but when I was working at Janus Henderson, they had this cool program where you get to take a day off, and they call it 14ers. I think there were 52 peaks in Colorado that are over 14,000 feet. I did 3 in one day, so maybe that gets me beating him on the 19 if you do some math. Let's see, most esoteric ETF. I'll keep going on the Janus Henderson theme. We had an obesity ETF. And then one other one I remember was not Janus, but it was a restaurants ETF, which I just kind of laugh at because, you know, how many times do advisors or clients come to you and say, like, I really want to play the restaurant theme?
Pet food. Pet food was another one. I think there was pet
yeah.
food.
Alien tech.
Dave Portnoy had Buzz, which actually might be a decent idea, most talked about, but
Very good.
no, spaghetti against the wall.
Well, we're at time. Thank you, panelists. This was very fun. Appreciate it. Thank you, everyone in the audience. Appreciate your time. Thanks for being here.